Assalamu alaikum friends. So this is part 2 of IFRS 9 and today's topic is compound instruments. Yesterday I have discussed financial liabilities, which was part 1 of IFRS 9. Now this is compound instruments. Under compound instruments, first we are going to go through the presentation. This I have already explained in IS 32 how compound instruments need to be presented. Okay, it needs to be presented financial liability. The part for the financial liability must be shown as financial liability, and the part shown which is for equity instrument needs to be shown as equity instrument. Okay, it needs to be shown separately. So now we are going to go, our main focus for today's topic is on the initial recognition of compound instruments, because yesterday when I was explaining you the financial liability, okay, I have explained to you two things matters: initial recognition and subsequent measurement. Okay, so now we are going to go through compound instruments. How do we initially recognize it? Okay, if you have missed out the definition of compound instruments, or if you want to know a little bit detail about compound instruments, you can check IS 32, right? Under IS 32 I've explained compound instruments. I'm not going to repeat again, and because I don't have so much of time to do it again. Okay, so now let us go to the initial recognition of compound instruments. On initial recognition, a compound instrument must be split into a liability component and an equity component. That's what it means. Initial recognition, you split between liability and equity. This is on the initial recognition. Okay. So first, when you split, which part do you calculate first? See, the other one is the balance. Okay, equity component is the balance. We always start with the liability component first. We don't calculate the equity component. If you try to calculate the equity component first, you will not be able to do it. Trust me. That's why you need to know this order. First is the liability component. Always. It's not an option. It's always the liability component first. Whatever is the balance is the equity component. See, when in the exam you will be given the value of compound instruments. That is the total of liability plus equity. Okay, so out of that total, once you get the liability component, let's say you have a convertible bond of 30 million. Out of 30, 20 you have got under liability component as 20. That means the balance 10. 30 minus 20, balance 10 is for equity component. Okay, so the liability component, how do you calculate the liability component? Okay, make sure that you know this also. It is the present value of the repayment. You will be given some repayment, you have to find the present value. To find the present value, you will be given the interest rate also, the discount factor. Okay, so the present value of the repayment discounted at the market rate of interest for a similar instrument without conversion right. That rate also they will give you in the exam. Okay, similar instrument without conversion right. That means what are we assuming? We are assuming that there are no conversion to it. It is fully liability. So at that, what is the market rate? So that rate only we are using to discount our present value of repayment. Okay, to get the liability component. Definitely we'll illustrate this with numbers. Equity component is calculated as the difference between cash processed from the issue of the instrument and the value of the liability component. Equity is what? Difference between cash proceeds and the value of the liability component. So liability component you have calculated here in the first one, and cash is the cash proceeds they will give you in the question. So that minus the liability is the equity component. Now let us do this illustration, and through this one illustration you will clearly understand how to do compound instruments. So on 1st of January 2001, DEN issues a 50 million 3-year convertible bond at par. So this is the cash proceed. Okay, at par. That means neither at discount, neither at premium. Sometimes you can issue at discount also, at premium also. So you have to see for that, or at par. Par means 100%. 50 million is the cash proceed. That means now you have to find the liability component. And this is a 3-year convertible bond. So bond is a liability. Convertible means later you can convert into equity. Okay. Now let us read the following information. There were no issue cost. Good, thank God. Coupon rate is 10% annually payable, annually in arrears on 31st December. Okay. Definitely you'll be given coupon rate. Bondholders redeemable at par on 1st of January 2004. That means after 3 years. Bondholders may opt for conversion in the form of shares, right? The terms of conversion are 25 cents equity shares for every $1 owed to each bondholder on first. So you have to know this terms of conversion. What is it? 225-cent equity shares for $1 owed to each bondholder. Okay. Bond issued by similar entities without any conversion right currently bear interest at 5%. You'll be given this interest for you to discount. Assume that all bondholders opt for conversion in rights. Okay. See, this is like a right you are giving, no? Whether you convert or not, you can convert it. But it's not necessary that you will convert it. You might not convert it. So they are assuming for this question that they are assuming that all the bondholders will convert it into shares. Okay. This is basically making your work easier. How will this be accounted for by Daniels? So how can you account this for Daniels? That is the question. Okay. Let's see in the exam also this type of question comes to you. Immediately, what should struck in your mind is that this is IFRS 9 compound instrument they are asking for. Sometimes they might write, sometimes they might not write that it's a compound instrument. So you should be aware that if they will clearly not say, okay, this is compound instrument, find the liability component, find the equity. Like this straightforward, they will not ask you. Come on. This is a professional level paper. So you can expect that it will be harder than what you've actually practiced. So they will never be direct. Indirectly, this is a they are asking you this the find liability and equity section because this is a compound instrument. You should understand by reading the case study what is it. It's a compound instrument or financial liability or financial asset or what is it. This is a compound instrument because bond you can convert to equity. So you have a proportion of equity plus debt in one instrument. That's why it's a compound instrument. And compound instruments you should know it is dealt under which standard. So when you're studying also, whenever you go through a question and you're stuck, just think, what is it all about? You will get one topic. Then how that topic is dealt under which standard, which IFRS or IAS. Then you will then you will know how to apply the standard rules and all. Okay. But you should be able to link with the correct standard. So now we are going to the requirements. Solution. Okay. If you see the solution, let me show you the solution. This is 1, 2, so it's 2 page almost. Okay. Definitely in the exam you will not be asked this long question. For just one it won't be a 2 page answer. Okay. This is just they are breaking down each and everything so that you understand it better. Okay. This is a good thing about Kaplan textbook that they break down every piece of information and make it so easy. The language is so easy to understand that anyone can understand. That's why I'm using this textbook. Okay. So we know that we have just learned that on initial recognition you must write this. Okay. Write this in sentence or in words. You need to write it. That's why I'm highlighting the important words. The process received must be split between liabilities and equity. So you should say that it must be split between liability and equity. So we are dealing with liability component and equity component. Liability component is calculated exactly the same thing what is given in the definition. Okay. Equity also same thing. Difference between liability and the cash component. Now we are splitting the process. Okay. So the cash payment should be discounted at with what rate? 15%. The conversion rate. Okay. This 15%. This one. Without any conversion rate you have to that's a discount factor. Always that is the discount factor only conversion. So now if you memorize this pro forma, okay, you should memorize. There is no option. This whole table you need to memorize because this will help you because whenever a compound instrument is asked from you, this is the way you have to do it. Exactly the same way. In a table form, this columns has to be there, this rows, this things needs to be written. Okay, so there needs to be 4 columns. Date, 1, 2, 3, 5 columns. One is date, you have to write the date, then you have to write this interest, principal, cash flow, discount factor, present value. Okay, and this is the liability component, then the net proceed of issue, then the equity component. So clearly they are showing that B minus A is equity component. Now let us start. It is on 31st December 2001. Okay, that you will be receiving only interest. Only interest. So 5,000 is the cash. Okay, how 5,000 is the cash? Your like this is the question. Coupon rate is 10%. Okay, that means that is the interest, and 50 million is your bond. So 10% of 50 million is 5,000. 5 million. Okay, that is your interest. This are in millions only. Okay, because they're dropping down the zeros. 5,000 means 5 million. Okay, so interest will be 5 million, 5 million, 5 million for the 3 years. In the fourth year, okay, which is 1st of Jan 2004, the next day after 31st December 2003, because for 3 years only we want. But in the first year, the day after that, you will be receiving the interest. You will be receiving the principal amount, 50,000. Or you can even write the same date, 31st December 2003. It does not matter, right? 1 day difference will not change your discount factor. So it's 50,000, right? The amount of the bond. So discount factor is 15%, and I'm sure that you know this how to discount. Okay, it's 1 divided by 1 plus the discount factor. To the you have to increase it to the power. This is to the power 1, 2, 3, and 3. Okay, because this interest and principal 5,000, 50,000 you will be receiving in the same year. This you can show in the same date also. Because most of you will be confused that because this is 1 day difference, why this is 3 and why this is not 4. Because the last installment you'll be receiving the interest plus the principal. So it's 3 and 3. Don't take 4 here in the power. Okay. So you multiply that, the cash flow with the discount factor, and you get the present value. Add the total. The total is a liability component. And what is the net proceed of issue? What is the amount of the bond? It is given in the question, 50 million. So 50 million minus this, the equity component is the balance. You see, it's very easy. Compound instrument is not at all hard. It is the easiest in IFRS 9 to split the liability component and equity component. Most of the people get scared by looking at the word compound. Don't don't panic. Sometimes the wording looks hard, but actually the concept is much easier than what you think. Okay. Now we are going to the measuring the liability at amortized cost. Why are we measuring the liability at amortized cost? If you followed my yesterday's lecture on financial liability, how do you measure financial liability, initial recognition versus subsequent measurement, you will know why I am saying this. Liability, you measure it at amortized cost versus fair value through profit and loss. You can measure fair value through profit and loss at amortized cost, but that is subsequent. Initially, you measure it at amortized cost, isn't it? Remember, we did this yesterday. Your subsequent measurement. You see? So subsequent measurement, one is amortized cost, one is fair value through profit and loss. So we did this table to understand amortized cost, right? So exactly this table we are following today also in this question. Because now you have split the liability component and the equity component. Don't forget that once you split it, you need to measure the liability at amortized cost, because subsequently you measure at amortized cost of fair value through profit and loss. Okay. So liability component is measured at amortized cost. The working shows the finance cost according to statement of profit and loss as well as carrying amount of the liability. Okay. So yesterday I've explained this table. You start with opening balance. The finance cost will be 15%. The interest which you have used to discount. Okay, the discount factor will be your interest. Do not use the 10% coupon rate as the finance cost. Okay, that 10% on 50 million what you have applied, that coupon rate will come here as payment. 5 million, 5 million, 5 million. Okay, so how do you start? You start with the opening balance for 2001. Which opening balance do you use? You start this opening. This is the opening balance. This liability component which you got, you start from there. That is the opening balance. On that you take 15%. Then you minus 5,000. Payment will be same only. 5,000, 5,000, 5,000. Okay, then you get the closing balance. Now this closing balance, if you see here, becomes the opening balance for the next year. It's repeated like that always. Okay, so that means when you do this, you have to do this horizontally like this. Okay, you have to do it horizontally. You cannot do it downwards like this, because to get this figure you need this closing balance of 2001 to get the opening balance of 2002. That means without this 2001 you cannot go to 2002. You understanding? You have to do year by year, except the payment. Only the payment remains fixed for all the 3 years. Rest all depends on the first year. Then third year figure will be dependent on the second year. It's like that. It's built up. So 3 years they have told. Now the conversion of the bond. So liability we know 50 million is the amount, and what is the equity? Definitely this will be shown in the statement of financial position, the liability, the bond and the equity. So this is the bond 50 million, and what is the equity? We have just got it, the balance, this. So the total is this. Okay, now we have to do one more thing with that. What is it? This part. What was the conversion terms? 2.25 equity shares for $1. Okay, 2.25 equity share for every $1. Therefore 100 million shares will be issued which have a nominal value of 25 million. You understanding? Read this. The conversion terms are 2.25 equity share. So 2.25 equity shares means you multiply 2050. 2.25. 2. So you are taking 2. 2 multiplied by 50 because 50 million is the value of the liability. Okay. That means how many? 100 million shares. Basically you are finding number of shares now. How many shares you will get? So 2.25 equity share for every $1 means, that means there is a share premium. There is a share premium related to this. Okay, 225. Okay, that means 2 shares for 50 million. This is the bond. You will be getting 100 million shares. It's always like that. Multiply the bond with the number of shares. So it's 2 because they told 2.25 equity share for every $1. Don't go and take. So this 50 is not 2 into 25. Okay, because they told 2.25 equity share. This 50 million is not 2 into 25 cents. This 50 million is this 50 million, the value of the bond. That means for one bond you will get 2 shares. So 1 into 2, 100 million shares. Which will be issued, okay, will have a nominal value of 25 million. That's what it means. 25. The nominal value will be 25 million. Because it is 25 cents for every $1. So for 100 million shares, it will be 25 million. Okay. Because 100 into 25 cents. 25 million, right? 100 into 0.25. 25 million. That's the nominal value. The remaining, what is the remaining? This should be classified as share premium. And this will go within equity. Anything relating to equity will go within equity only. Whether it's share capital, share premium. Okay. Because if you see this, just see the total amount. It is this, right? So this, you have to deduct 25 million from there because 25 million is the value. First, always you start with the number of share. That is 100 million. Then you find the nominal value, which is 25 million because 25 cents into 100. Then this 25 you deduct from this. Why you are deducting 25 from this? To get share premium. to get share premium. So the balance 3708 should be classified as share premium and it will be within equity. There is no remaining liability because conversion has extinguished it, right? Now the double entry. Other components of equity, debit, liability, credit, share. So share capital and premium will be credited, liability will be debited because liability will go off. Once you convert it into share, there will be no liability. So liability totally, fully 50 million will be debited. No liability will be there. Share capital, credit 25. Just now we got this 25 million value of share, then share premium. Okay, you need to calculate that share premium. If you see, you can see this is 25 cents for one 25 cents equity share. If it was $1, that means there is no share premium. Because it is 25 cents, definitely there's a share premium. So you need to find the share premium. And other components of equity is debit. This one, 57081. It is this one. Initially, what you have got for equity, it is debited. Okay, because it will go off. And make sure once you do double entry, always whenever you do double entry, your debit should balance with your credit. If it does not, then you need to recheck your calculations. If you see, add this and this, the debit side, it is 5708.12. If you add this two also, it will be same. The share capital and the premium 5708.1. So it balances. Now the next is test understanding 4. Test understanding 4 will be doing now. Okay, before that, note that the board has issued a discussion paper on the topic of financial liabilities and equity, including compound instruments. This is examinable. Current issue is covered in chapter 23. We are definitely going to go through this. Right? There's a discussion paper on this part. Relating to compound instruments also is there. So, and it will come in your exam, so we have to go through it. But discussion papers and all, after I complete all the standards, IFRS and IS standards, we'll go through it. Okay. So next we have financial assets, but we are not going to go through it here. That will be covered in the next video. So now let us go through this test understanding 4. Okay. If you have the textbook with you, okay, that's good. If you don't have the textbook with you, take a picture of this question so that we can go to the solution and see the answer. So that we don't have to keep revisiting the question. When we are going through the answer, we know what is the figures and all. Okay. So Craig issues a 100,000 4% 3-year convertible loan on 1st of January 2000. The moment they say convertible loan, it is understood this it's a compound instrument. Okay, this is the easiest word for you to know whether it's convertible or compound instrument or not. The word convertible loan will say. Okay, so you have to highlight all this. So 3-year for 3 years you have to do 4%, 100% the market rate. So the market rate, they will always give you the market rate of similar loan without conversion rate is 8%. The conversion terms are 1 equity share, 1 is the nominal value for every $2 of debt. Okay, that means you will have half of debt. Okay, 1 for 2 means whatever debt you have, half of that will be your equity. You will get equity. Okay. Conversion or redemption at par takes place on 31st December 2008. That is after 3 years. How this should be accounted if all the holders elect for the conversion, if no holders elect for the conversion. Now we'll go through test understanding 4 to say this. So test understanding for this one. Okay, it's quite long. Okay, so here the accounting entries are both okay. Now we have to split. Okay, we have assumed that we are going to take the conversion. If we take the conversion, we have to split the proceed. Okay, The cash payment will be discounted present value using interest rate at 8%. Okay, so here also same. Okay, make sure that you have the question in front of you. So now it becomes easy. I don't have to go back to the question because this chapter is pretty long. If I go back, I have to go. It will take a lot of time for me to go back to the question. So keep the question in front of you. It was 4% on 100,000. That's why cash flow will be 4,000, 4,000, and 100 plus 4,000. In the third year, interest plus principal. Okay, when you are taking the cash flow, it is the 4% on 100,000, not the market rate. You don't take 8% on that. That 8% is used for discount factor. Okay, so now you discount it, then add all the figures of the total is known as a liability component. What is the value of the bond? The convertible bond is 100,000. So the balance B minus A, the balance is equity component, right? Now we are going to go to the finance and carrying amount. This is what we are this is known as amortized cost. We are valuing the liability using amortized cost. So you start with this 89692. This is this balance only for A what you have got. You start with that. So don't stop at this table. Once you use this table to split the component, remember to value it. You have to use this second table. This is known as amortized cost for the liability. You need to do this. Number 2 is also there. All the steps needs to be done in order 1, 2, 3. So you start with that. On that you take 8%. You take 8% on the opening balance. Okay, 8% is the market rate that you have used to discount. You have to use that interest rate. Don't get confused between the market rate of interest and the coupon rate given to you in the beginning. So coupon we have already calculated the interest 4,000, 4,000, 4,000. It will be fixed for all the 3 years. Then you get the closing balance. So we know this closing, the first year's closing balance becomes the opening balance for the next year. And hence again you take 8% minus 4,000. So each year it keeps repeating until you get this amount. If you see the closing balance, it should be equal to the amount what you have given, the convertible instrument, 100,000 only. Initially given to in the question. It should always be like that, the closing balance. Now, third working conversion, you need to do this. What is the carrying amount? So whenever you calculate the carrying amount at 31st December 2008, year end, what do? This was the equity. This was the liability, the bond. Okay. So with this 100,000, you add this equity. 10,308, which you have got in working one. Okay. Now one might ask, okay, before I go to conversion, what might have this doubt also, which I forgot to tell previously, that why we are adding this again here. What that you must be thinking that this 10,308 is included in this 100,000, right? Right. So that's why are we adding this? No. When see in one, this 100,000, it is the net proceeds of issue. Okay, we are receiving this much. Okay. Out of it, what is the liability component and what is the equity component? But this amount will remain fixed only. This is only our convertible bond, 100,000. With that, we have to add this equity component. In the statement of financial position, that will be the carrying amount. Okay, the convertible bond and the equity component. So 100 and this equity component you add, and then you have to do this. If the conversion price exercised, then 50,000, because 100,000 divided by 2. You don't take this amount and divide by 2. You only take the liability part, the bond. Okay. So equity shares one are issued and equity shares of one are issued, and this one is classified as share premium. What is classified? This one. This minus this 50,000. The balance, this one is known as share premium. Okay. Because of that share premium, we are having this difference. with this and this 50,000. That's why it increased so much. Okay, we'll always have that share premium part. Now we are going to the redemption. The carrying amount are the same under 3A. One on redemption, the 100,000 liability is extinguished by cash payment. Okay, so when you make cash payment, this 100,000 will go totally. Equity component remains within equity, probable and non-distributable reserve. Equity, it will be there under equity. Okay, so we are over with it. Test your understanding. 4. Okay, so that's it for financial compound instruments. I hope now today you will go and do compound instruments and do questions on it and try to find out questions from your revision kit before I actually upload the videos on those questions, and you try to do it so that until you become an expert or a pro in IFRS 9. Okay, easy things you will anyway do it, you will do it good, but what matters is if the hard thing also you understand properly and you are able to do at least 50% also, you will pass this paper SBR. There is no doubt about it. Okay, so see you in the next, and the next will be on financial asset. Till then, take care and God bless you.